This is Casey Cummings, President and CEO of RAM Realty Services, RAM Development Company, and things related. And we are delighted to have him here. We've known Casey for some time, and we know him as an extremely articulate and thoughtful representative of the industry, and I think that will speak for itself when he gets up here. RAM, just a bit about it, I'm sure he'll tell you more. Currently has something like $1 billion in assets under management, 4.5 million square feet of retail, 2,500 or more units of multifamily, and they work in target areas in the southeastern, several states in the southeast, up to the Carolinas, and have something north of 120 employees. Okay. And many of our graduates have had the experience of being part of their firm, and have had a great experience there. And they're, just to, I think you might hear a little about this, but they're putting together funds. They've been involved in acquiring distressed debt and working with the challenges of that sort of thing to the tune of something like $300 million. And so they are a very, very active and adventuresome firm, and we're delighted to have Casey here to tell us how the world looks. So welcome back.
Great, thanks. Adventuresome. That's what you said, right?
Yeah.
Adventuresome. I like that. Welcome. Thanks for having me. I need to, let's see, I'm going to open this.
There you go.
And I'm going to open, does that look familiar to you? And I'm going to open this. And I'm going to, so bear with me one second. Okay, so let's see, it's a little bit after 4. Suppose we have till 5:30. I am going to try to be relatively brief with my comments because I really prefer questions. I really prefer having a discussion rather than me lecturing to you. So be thinking about questions. Spent a little bit of time with some of the students earlier and had a lot of great questions. So what I'm going to do, I'm going to tell you a little bit about our company, a little bit about me. I'm going to tell you a little bit about how our company works today, which is different than how our company used to work. And I'm going to try to keep that as brief as possible. And then I'm going to tell you a little bit about what we're doing today, some recent transactions we've done. And then I'm going to wrap up with telling you a little bit about how I see and how our company sees the current environment, which may or may not be uplifting to you, but I'm going to tell you what it is I think. I haven't consulted with anyone about what I'm going to say, so if it comes out odd, I apologize, but my goal is to get at least 7,000 hits on YouTube from whatever it is I say. So first of all, a little bit about our company, and these are not really in order because I'm not as well prepared as I should be. But does this look familiar also? He used to work for us. He started us on all these great graphics. So our company was founded in 1978 by my father. And it was founded around a large master plan community, a 2,600 acre community in a little town called Palm City, which is down in Martin County on the west side of Stewart, about 30 minutes north of West Palm Beach. So that community today is home to over 10,000 people. And actually the community got, while the company was started in 78, the community got its final approvals in August of 1980. And actually just this last August, so about a month ago, we actually sold our last asset in the community. So it only took 33 years to execute that business plan. I can assure you that the original plan was a lot shorter than that. And that actually shapes a lot of our thinking as to how we do business today. So that's how the company was founded. I joined the company in 1991. I went to Boston University. So that's why I root for the Gators in football, because while I was at Boston University, imagine this, they actually canceled football. They just ended the football program. Could you imagine if they did that here? We do not have a football program, but I did enjoy going to school there. I studied finance, and while I was still in school, I started a small business, sold the business, and then joined my father's company, really originally to help him sell golf course memberships, and it sort of spiraled from there. So my father's still the chairman of the company, and we work together, although we've never actually lived in the same town and worked in the same office at the same time. So it probably has a lot to do with why we have such a good relationship. So the company up until 1995 or 96, pretty much everything we did was centered around this large community or other assets that, that our family had owned. And it also centered around capital that we ourselves had. So we really didn't have outside capital, and we really didn't do a lot of projects that weren't centered around this project called Martin Downs. And then in the mid-90s, we started doing projects outside of Martin Downs, and primarily shopping centers and apartments, which is what we do today. And little by little, we started to have other families ask us, gee, it looks interesting what you do. You seem to be successful. If there's ever any room for us to put capital with you, we'd be interested in that. So we started accepting capital from other families to invest alongside of us. So that was the beginning of us working with outside capital providers. So that was through the mid-90s. And then in 1998, my father and I got together and we talked a little bit about the future of the company. And while it's a family-owned business, it's very important for me, I felt, for us to grow the business that we needed to recruit a professional management team. So we started at that point in time putting together our senior team, most of whom are still with us today. And then again, we were doing projects with our own capital plus other capital. And then in 2000, 2001, we started as our projects got larger and we got more successful, we started to do institutional joint ventures where we would put together a project and we would attract institutional capital to invest alongside of us. So really a kind of a crawl, walk, run kind of process. We did smaller projects with our own capital, slightly larger projects with our capital and other families' capital, and then ultimately larger projects with institutional capital. And then in 2004, we started to do, we raised a private equity fund where we had 11 investors, primarily banks, one pension fund that really was a sort of socially motivated, and also an insurance company. And we raised capital to buy shopping centers in low and moderate income areas in Florida. The objective was to make money and also to do good by fixing up properties in moderate income areas. So we did that in 2004. And then in 2007, we raised our second fund, which was $195 million of equity. And that had about 25 investors, ranging from individuals with about $1 million all the way up to institutions, insurance companies, pension funds. Our largest investor at the time invested $45 million with us in that fund. And that fund was started raising it in 2006, finished raising it in 2007. And that fund was raised to do development and acquisitions of shopping centers and apartments throughout the Southeast. So you can imagine we made some early investments in that fund. And as you can imagine, 07, 08, as the market started to turn on us, things got more challenging for us. So we invested about 40% of that money before the Lehman collapse, if you will, and then the other 60% after. So the early deals we did, believe it or not, the deals we did when times were really good wound up being our worst deals, which I'll talk a little bit about in a minute. We took a 1-year break from investing. We basically didn't invest any capital in 2008. That's primarily because we were in a fog and had no idea what was going to happen. It was a very challenging time to be in our business, no visibility, we weren't sure which direction things were going. Those of you that were in business then as opposed to in school might have remembered some of those things. I actually had a friend that was owned a large bank, a large private bank, and I was with him during the summer, I think it was 2008, and he told me, he's like, I'm worried about where to put my cash. I'm worried about, will I be able to have access to cash? I'm scared about just protecting cash. So when you're talking to people that you respect in business and they're talking about worried about what bank their money's in, it's hard to get conviction about investing capital. You're really more concerned about protecting capital. So we didn't do much investing in 2008. And then in 2009, we resumed investing that capital that we raised and made a lot of investments, most of which turned out really good. We actually bought, and I'll answer some questions about this, about how that works, but we actually bought 60 defaulted mortgages or non-performing mortgages over about a 3-year period, all secured by shopping centers and apartments, a little bit of land as well. So we bought those mortgages, mostly foreclosed on them, and took control of the real estate. And then in 2011, we finished investing our second fund and we started raising our third fund. We finished raising our third fund earlier this year. We raised about $150 million, and we've been deploying that money really since late 2011, and we're still deploying it today. We're about 40% deployed. So we've done, I think it's about 95 different transactions, separate transactions since 1996, since we started taking outside capital. We've averaged about a 20% return. We used to average a much higher return. Our average really was drawn down by some deals we did in 2005 and 6 that wound up not being so good. So we actually, up until 2006, we had never done a deal that lost money. And that changed, though. So a lot of great lessons learned then. So that's a little bit about the company history. I think the other thing to share with you about our company that I think is somewhat unique is our company, in addition to raising the capital and deploying the capital, almost everything we do, we execute ourselves. So we have our own management team, our own leasing team, our own development team. So we execute our own business plan. So there are a lot of firms that have management organizations that do work for capital providers, and then there's a lot of firms that raise capital and deploy it with other people that do the work, typically called operating partners. We're one of the few firms that do both. And some days that feels like a really good idea, and other days that feels really difficult. So we're fully integrated. So we are primarily only interested in investing our capital when we can also use our people. So we don't do third-party work. If you owned a shopping center and wanted us to manage it, we wouldn't have any interest in managing it unless we could own a part of it. And that's really because we believe that real estate, at the end of the day, is fundamentally an operating business. It requires people. It's like running any other business. Very people-intensive, very human resource-intensive. So that's the company history and a little bit about what we're doing. I'm going to skip through, tell you a little bit about what we're doing today, and then I'll talk about some recent transactions. So today what we're doing is really 3 things. And it's funny, this presentation was put together in 2011. It's actually put together in early 2011, and it's been updated every so many months since then. And what we said we were going to do in 2011 when we started raising the money is a lot different than really what we're winding up doing now. And things have changed along the way. Things have actually gotten better in terms of asset values. They've gotten better much faster than we anticipated, and I think probably than a lot of people anticipated, which is good and bad. So our plan, our original plan, and we've executed on a large part of this, is to buy distressed debt, to do acquisition and repositioning, which we call value-add investing, which is buying things that are old and tired that need work and fixing them up. And then also special situations, which is generally speaking putting our capital into other people's transactions, helping recapitalize people that are short on equity, helping fund projects that need capital. So first on our distressed debt strategy. So we buy and have bought non-performing and sub-performing loans. And so a few of the things we specifically do in terms of our disciplines is we only buy whole loans. So I don't know if you've learned about this yet. If you haven't, you will. You know that a lot of the loans that are issued on real estate, that are made on real estate, end up getting securitized. They get packaged and they get turned into a financial instrument, into a security. And the ownership gets spread out among bondholders. So we're only interested in buying the entire loan. So in addition to loans getting securitized, sometimes they get split. Somebody will take the least risky piece, somebody will take the most risky piece. We want the whole thing. We don't want to be dealing with a financial institution, an insurance company, a trustee, a mezzanine loan provider. We want the entire thing because we want to be able to decide what it is we're going to do with the borrower and what it is we're going to do with the asset. So of the 60 loans we've bought, 100% of them have been the entire loan. We've never bought less than the entire loan. The other thing we do, I think in all 60 circumstances, is we've only bought first mortgages. We've never bought mezzanine loans, junior loans. We want the first mortgage because, again, we want the senior most instrument because we want to be in control of the collateral if the borrower defaults. And the other thing we do that a lot of buyers didn't do and don't do is we underwrite everything as though we're going to own it. A lot of people who made a lot of money buy debt to trade it. They buy it at 40 cents because they think in a few months they can sell it at 50 cents, which, by the way, is a lot easier than what it is that we do. We should probably think about doing that in the future. But right now, we underwrote everything we bought as though we were going to have to own it. And of the 60 loans we bought, we wound up owning about 45 or 50 of them. The other 10 or 15 or so, we either restructured with the borrower or the borrower agreed to pay us off either in full or at a discount. So that was a big part of our business. That was probably 75+% of our business in 2009, 10, and 11. And actually the first 2 investments we made in our current fund were distressed debt investments. The last one closed in the fall of 2011, and we haven't bought a single piece of debt since then. That's the first part of our business. The second part of our business is acquisition and repositioning, where we're buying shopping centers and apartments. We want to buy them in infill locations, so we want to buy them where most of the land around it has already been developed. We want to buy them at a discount to replacement cost, and I'll talk a little bit about that in a minute. And some of our differentiating factors is we're comfortable when there's a lot of work to be done. We're comfortable when the deal's messy. A lot of groups that buy value-add deals like it when there's less work to do. They like it when the execution's more simple. We're happy to have those, but we tend to buy deals that have more work to do. We're after higher returns as a result. So let me talk about replacement costs for a minute and why buying at a discount to replacement cost is important. So you will hear people when you get in the business, if you hear somebody make a pitch to you or you make a pitch to somebody yourself, unless you're doing development, everybody will talk about why this thing I'm buying it at a discount to replacement cost, therefore it's a good deal. The reason why things trade at a discount to replacement cost is because most things, or a lot of things, aren't worth what they cost to replace. Happens frequently. So people take this comfort in, I'm buying something, if I were to build it new, it would cost me $200 a square foot. I'm buying it for $125. Or I'm buying it for $100. It's half off. It must be good, which is a trap. It's a mistake. So the reason why we take comfort in buying it at $100 a foot versus new construction at $200 a foot has more to do with the threat of new supply. So if we're buying something at $100 a foot, it's probably because the rents today only support $100 a foot. So the benefit we get from buying at a discount to replacement cost is the rents would have to double to support the returns required for somebody to build something new. So the reason why we take comfort in a discount to replacement cost is it's another sort of protection against new supply, right? And since we're buying in the Southeast and we're not buying in New York City or San Francisco, most of the areas we're buying in, there are opportunities for other people to build a newer, better mousetrap. So as long as we're buying at a discount to replacement cost, rents would have to rise so much in order to induce somebody to build something new that we think that gives us protection against new supply. And if the rents rise that much, we're happy to sell our asset to somebody else. So that's why we think discounts to replacement costs are important, and I'm happy to answer questions about that later. The third part of our business is special situations, and what most people put that tag in their book when they've got a bunch of other things they want to do that don't neatly fit in the first two categories, so they say everything else is special, which is, it's a catch-all. So for us, what that means is what we have done, we've done it a couple times, where someone else owns an asset and has run out of capital and can't get debt, can't increase their debt, can't get debt financing, and they need equity. And we've provided that equity to help somebody through problems. So we did it a lot in the downturn. Somebody owns a shopping center, they don't want to get rid of it, or they own a shopping center and they need capital to buy out their debt at a discount. We provide that capital. So we did a fair amount of that. Today, what we're using that for is more to fund ground-up development deals, primarily apartment deals. So those are the three pieces of our business, really in our fund business. We also do development on our own, a little bit of that, which I'm happy to answer questions about. So let me try to find in this presentation a couple of examples of recent deals we did that are examples of each. So let me talk about this deal. And I know there's a lot of words up here. It's not really designed for this kind of, I was lazy, as you know. I just took what you made and did this. So this is a transaction we did in Plantation, Florida, which is just on the west side of Fort Lauderdale. We did this transaction in 2011. We bought a first mortgage secured by a Publix anchored shopping center. We bought it for 55% of par. So the balance due, whatever the balance due was, we paid 55% of that. We worked with the borrower. We were going to do a partnership with the borrower and ultimately decided not to. So the borrower was not paying on the debt. We foreclosed on the debt and we took title to the property. And so we paid a 9.9%, what we refer to as a 9.9% debt yield. When you buy debt, the yield on the asset is a percentage of what you paid. It's like a cap rate, except when you're buying debt, you refer to debt yields as opposed to cap rate. So we paid close to a 10 debt yield on an asset that at the time probably would have traded for about an 8 cap. So we got a big benefit in buying just by being willing to buy the mortgage, which a lot of groups like us don't do. They don't have the capital to do it. They don't have the expertise to do it. So we bought the mortgage, foreclosed on the asset, and since we foreclosed on the asset, we've extended some leases, we fixed up the shopping center, and now we're running it, and we'll probably own it for another couple of years, keep leasing it up, and then sell it. So we made a fair amount of money just by buying right, and that's really where having a fund is important, because when we did this transaction, we bid in an auction format to buy it. It was actually an online auction. Right? Was this an auction.com deal, Jim? So it was an online auction. We bid just like you'd buy golf clubs on eBay, literally the same way. We had to do all of the due diligence in advance. Normally you sign a contract and have a month or two to do due diligence. We had to do all of it on our own in advance. And you bid online, and you keep bidding. And if you're the winning bidder, within 24 hours, you have to post 10% of the purchase price. So in this case, that was about $1.5 million we had to post. And then 10 days later, you had to close for cash. So in this case, it was about $15 million. So what we loved about this process is that it was so crazy that nobody else would do it. So, and that we had our own capital. We had already raised capital so that we were able to take advantage of it. And I talked about this a little bit earlier. One of the benefits of having a fund is, if you're lucky, what happens is you raise capital when times are really good and everyone wants to put out capital. Then you have it raised and then things get bad. And when things are bad, nobody can raise capital. And that's actually the best time to deploy capital. So we were fortunate in this particular case. We had some capital raised, people were still afraid. People didn't have capital raised for this kind of thing, and so we were able to buy it, we think, relatively cheap. So that's an example of a debt transaction. So I'll give you one other example, and then I will stop for some questions, and then I'll give you my opinion sort of what's happening now. So this is a transaction. This is called Alton Point, which these pictures don't do it justice, but we bought, again, we bought a first mortgage. We bought it in the first part of 2009, late 2008, secured by about 125 apartment units in Miami Beach. And so we bought the first mortgage, we foreclosed, we did a gut renovation of the property, leased it up, and sold it. It took us about a year for the foreclosure, a year for the renovation, a year to lease it up, and then we sold it. And this deal we made about a 20% IRR. The Jacaranda Plaza deal I showed you before, we think we're going to make about a 20% IRR on that deal as well. You'll notice on these slides, you probably can't see it, but there's a thing called multiple on invested equity. Some people refer to it as MOIC, M-O-I-C, or some people just refer to it as the multiple. So for us, that's as important, if not more important, than the internal rate of return. And the multiple on invested equity is just simply if you invest $1, how much do I give you back? So if you invest $1 and I give you back $2, that's a 2 times equity multiple. So you can see why the way we work, we get a percentage of the profits. So for us, multiple is as important as IRR. So you could have a huge IRR. You could have a 50% IRR. If the money's only out for 3 months, you only made 12% on the money. There's not a lot of actual cash to go around. So we're focused on multiple as much as we are on IRR. Let me see if there's any other pretty pictures I can show you. These are all just other transactions we did. This is a ground-up development in the Windermere area of Orlando where this was a special situation. We funded a developer to build a Publix. We funded the developer in September of 2010. There was no capital for development in 2010. So we knew the developers. We were comfortable with them. They had a lease signed with Publix. We obviously like Publix. We had capital, and they really needed capital, and it was hard to get capital from anyone else. We were confident in the transaction, so we funded them. We worked with them to build the property, and the asset sold not long ago, and we made a 58% IRR and a 2.4 times multiple. Again, not that we did anything spectacular on the execution, it's just that we had capital. We were confident to deploy it in 2010 when other people were scared, and we were able to earn really an outsized return as a result. These are some mortgages we bought. Just trying to see. And really the rest of this is frankly more of the same. So let me go back here. And I guess one other thing I'll share, and then I'll open up to questions, and then I'll get into sort of how I feel about the current environment. So the other thing, I think I mentioned this, we have about 125 employees, and one of the reasons we raised, and I don't know how many people know how a private equity fund is structured? Raise your hand. Okay, I'll talk for a minute about that. So our funds, and this will be somewhat repetitive for those of you that were with me earlier, but our funds, they're commingled, so we have multiple investors in one partnership. Okay, they're private. They're privately placed. We don't issue public stock. We're not traded on the stock exchange. So commingled, private. We only take capital from accredited investors or institutional investors. So there's a minimum requirement in terms of net worth and liquidity. So our minimum investor really is $1 million, and that's really more friends and family. The real minimum institutional investor is more like $10 million. We have full discretion over the capital. So when they invest in our concept and in our team, the investors don't decide whether they want to go into one transaction or the other. They go into all the transactions. They invest in the partnership. So think of it like an umbrella partnership, like a master partnership. So we raise this capital from institutions and from private individuals, mainly from family offices, and we agree to deploy it over a certain period of time. So in the case of the current fund, we raised $150 million. We started deploying it in late 2011, and we've promised the investors that whatever we do that is, value add or distressed investing or special situations, shopping centers and apartments, the Southeast, whatever we do is going to go into this partnership from 2011 until about 2015. So all of our deals are going into that bucket, into that partnership. We call capital as we need it, and we'll probably make about 20 different investments. So these investors invest in the partnership, and the partnership makes the 20 investments. We get paid a fee for doing that, and then in addition, we get 20% of the profits. That's a simplistic explanation. So we call the capital as we need it. When we sell assets, we start returning the capital. Once the investors get back their money plus a preferred return, we get 20% of the profits. So we started raising money that way. So if you think about it, it takes about a year to raise the money. We're typically finishing the prior fund while we're raising the money. And then we raise the new money. After we finished investing the prior fund, we start spending money out of the new fund. So there's usually about a year or two break in the middle when you're not raising money, but you're really always raising money, just not as active. So the benefit of raising this capital this way is that, as I mentioned before, if we would have gone, I'll get that Publix transaction as an example. If we would have gone to a bunch of investors because that deal closed in September of 2010, we probably started working on it in early 2010. If we would have gone to a bunch of investors and said, we want to build a Publix shopping center in Orlando, they would have said, well, it's out west, there's not enough housing yet. Why would you do that when you can buy debt on the cheap? We're not sure, we're scared. It would have taken us a year to try to figure that out. So the benefit of having raised the capital is if you decide you want to do something, you can deploy the capital. Same thing with that mortgage that I told you we bid online. Same kind of thing. We would have never been able to get the money together fast enough. So we raise this capital every few years, then we deploy it over a few-year period. And we get a modest fee stream from doing that, coupled with property management fees that help support the company. So one of the benefits of doing that is it's really provided sustainability for our company. So before we did that, the way we would earn revenues at our company would be really transaction-based. If we did a deal, we'd earn money. If we weren't doing any deals, we weren't earning any money. So this is a steadier flow of capital. In good times, it's less profitable. In bad times, it's less risky, and it's much more steady. So that's why we've raised capital. So really, it's more to take a long view. It gives us an opportunity when we have new people join the firm. They understand the path, they understand the plan for the company, and it really promotes sustainability in our company, which is important to us. So I'm going to stop there and see if you have any questions, and then I'll talk a little bit about my view of what's happening in the current environment.
What do you do with the money that you have in that 2-year period that you're waiting to make an investment? Are you investing that elsewhere?
Good question. So that would be, if they gave us all the money right away, that would be bad because it would lower our returns because all we would do with it is put it in cash or put it in some safe investment. So what happens is we call the capital as we need it. So when the investors subscribe to our partnership, we have a 3 or 4 year period over which we call the capital. So we issue a capital call. They have 10 days to fund the capital call. What we actually do is we take all those capital calls, all those subscription agreements, and we go to a bank and we say to the bank, look, we've got 20 investors that have subscribed for $150 million of equity. Here's who they are. And we'd like a line of credit against those pledges, against those subscriptions, so that we can function. So we typically will buy deals on our line of credit, And then about once a quarter, we'll send a notice to the investors. This quarter, we bought these 2 deals. This quarter, here were the expenses. This quarter, our fees were X. It totals X. Your share is 5% of that. Send us your money. And then they send the money 10 days later. So we have the fund probably keeps, the average fund on average probably keeps $2 or $3 million of cash balance. It just gets invested overnight, earning 0.000% or something like that. Yes? Right. Right. Good question. So, for those of you that don't know, I'm not a lawyer, and I know there's lawyers in the room, so don't correct me. Don't make me look bad up here. So, there are 2 types. Foreclosure is handled in state courts. There's 2 types of systems. Some states have what's called a judicial system, which Florida does, which is in order to foreclose on a property, you have to go through a judicial process. You have to actually file a lawsuit. And so it goes into the court system, which obviously creates delay and complexity and cost. But the borrower is afforded all the rights that any defendant in any lawsuit is afforded. They can countersue, they can delay, and so forth and so on. There's other states, which are called, the way I know it, is deed and trust or non-judicial states, which is when you make somebody a loan, the actual deed to the property is held by a trustee. Kind of like car loans. It's like if you buy a car and you borrow the money, somebody else actually holds the deed. So there's a trustee that holds the deed. In these non-judicial states, you send a notice to the trustee. The borrower didn't pay me this month. You copy the borrower on the notice. You tell the trustee, I want you to schedule the deed for sale. The trustee runs ads in the newspaper like 3 weeks in a row. And if the borrower hasn't paid, trustee schedules a sale. The trustee's typically a lawyer. At the lawyer's office, gets advertised when it is. You show up at the sale and you bid. And if you're the lender, you bid your debt. It's called credit bidding. That takes like 6 weeks, 8 weeks, 60 days, and costs very little money, $10,000, $15,000. In Florida, so non-judicial states would be Georgia, North Carolina, Tennessee. Judicial states would be Florida, South Carolina. So in those judicial states, it takes a minimum of a year, sometimes longer. If the borrower doesn't contest, it can be faster. But it takes about a year and cost every single time. If it's contested, it costs at least $100,000. We've had some times where it's cost $500,000. The borrower files bankruptcy, takes 2 years. Bankruptcy is federal, so they can use bankruptcy in these non-judicial states as well to delay you. So in Florida, we just budget a longer period of time to get control of the asset and a higher expense. And in other states, we budget a much shorter period of time and less money. So what that does, if you think of it, and I don't know where you are in your coursework in terms of doing discounted cash flow analysis, but run a discounted cash flow analysis and calculate, a net present value or calculate an IRR, pick a starting value and calculate an IRR. Do that same thing, got it open in Excel, and then, insert, if it's a quarterly cash flow, insert 6 columns, and instead of having cash flow from the property in the 6 columns, put negative $75,000 for legal fees. So time 0 is I bought the asset. Quarter 1, minus 75. Quarter 2, minus 75, and so on for 6 quarters, and then you finally get the economics of the investment. That's how we underwrite in Florida. So it obviously has a dramatic impact on the value of the asset. So if we were bidding on a loan, apples to apples, if it were in Georgia versus Florida, same quality asset, same situation with the borrower, we would either make more money if we bought it in Georgia, or more realistically, we'd have to pay a little more if we bought it in Georgia, because the process is faster. The other thing you have to underwrite, which is, like more psychology than real estate, is what you think the borrower is going to do. Because if you think the borrower is going to contest, then even in Georgia or Tennessee or North Carolina, you have to budget more because it's going to take longer. And getting inside the head of the borrower, it was easy in the beginning because most of the loans we bought in the beginning, we knew the borrower. So we already sort of had a deal cut with the borrower. But in the end, a lot of the deals we did, we didn't know the borrower. So we had to ascertain how we thought the borrower would behave. And we were wrong just about every time, right? So we thought people would fight us, and they didn't. We thought people would definitely roll over because they had a lot to lose. And they fought us. So the one thing for sure is that the closer, this makes sense, the lower discount we paid, so the higher price we paid, the higher the likelihood that we were in a fight because the borrower was closer to being in the money. The other thing we learned, which was shocking, is we bought a lot of non-recourse loans where our rights to sue were just at the property. All we could do was take the property, versus recourse loans where we had rights to sue the borrower personally for failure to pay. So you'd think that you'd get less of a fight on deals where the borrower had personal recourse because they would have more to lose if they fought with you. The reverse was true. We had less of a fight on the non-recourse loans and more of a fight on the recourse loans. And I could talk for 2 hours about why I think that is. And if you're interested in that, I'll answer it for you after the class. Somebody else had a hand up, yes. That's a really good question. Historically, if you look at dollars invested, it's been about 50-50, maybe 60-40 retail, but call it 50-50, close enough to 50-50 to call it 50-50. By number of transactions, it's been probably 3/4 retail, 1/4 multifamily. In terms of our scale and size, our market share and our competitive position in Florida or in the Southeast, we're a bigger player relative to our competitors in retail than we are in multifamily. In terms of our view going forward, we believe right now is a very good time, although it has been for a couple of years, so the question is for how much longer will that be true, to build apartments. I think it's a very challenging time to build shopping centers. We think it's a good time to be buying retail, although it's gotten more challenging lately. And pricing for apartments is, the only way to describe it is it's sort of gotten out of control relatively quickly. It's much more competitive to buy apartments. Long term, my view is apartments are a safer, steadier bet. Retail's a tougher bet, but there's potentially better returns. And I'll take a moment. I think this is interesting. You guys may think this is boring, but Jim's probably sick of hearing this. But the reason I believe this is the case, and I don't need to lecture you about the threat of Amazon and the internet on retail and do we have too much retail? You guys get all that. What's happened in the last, call it 10 years, maybe 20 years over time, is if you were to take a submarket and you were to plot on a table all of the apartment communities in that submarket from, let's say there's 100 of them. Everything above 100 units, everything that's been built since 1970. Say pick some sort of parameter. You could plot the quality of those deals on a line, and the line would be relatively straight. Like the 100th worst one, the 100th place, would be just a little bit worse than 99, be a little bit worse than 98, and so on and so forth. The first one would be better than the second one. The 20th one would be just a little bit better than the 21st one. They'd be, the worst one maybe is 80% leased, and the best one is 98% leased. Okay? And so you could look at any segment you want, and if you're wrong, like, oh, this one I thought was pretty good, but it's a little worse than I thought. So my occupancy is 86 instead of 91, and my rents are $1.02 instead of $1.12. There's this grade along the way, sort of this spectrum. If you were to go to the same submarket and plot the 100 shopping centers that are there, minimum 50,000 feet, built since 1970, whatever the case may be clear to you which the best one or the best 10 are. And the best one is a little bit better than the second best one, a little bit better than the third best one. But you'd reach a point, and I'm guessing, but let's call it the best 20%. Like the drop off from there is steep. And the worst one is empty, or it's going to be empty. The 80th worst one is 40% occupied and probably needs to be knocked down. So there's a wider range of outcomes. What that creates is an interesting opportunity, because if you can identify the 10 best or the 20 best and you can figure out a way to buy them or build them or own them, that's probably more special and more important than in the apartment business. So it's tougher, but there's a certain specific amount. And the other benefit of retail is there's less capital chasing retail. People are more scared about retail, which makes it a better investment, given that you pick the right asset. Yes?
So tell us about your thought on multifamily in a, given how tight cap rate environment on multifamily, and the ample liquidity that's driven there by the government in a rising interest rate environment, those two factors.
So you're saying interest rates are going up? Is that what you're saying? Eventually, right? They're going to go up. So what do I think about that? I mean, I think it makes our business extremely hard today. We are. This is probably an interesting slide for that question. This is the red line on top is the average cap rate for an apartment property in the U.S. Okay, so it says, it's implying right now that it's somewhere around 7, a little over 7. I mean, I don't know where that apartment complex is nowhere we're looking, right? They're all more like 5.5 or 6. But ignore the number necessarily, right? Think more about the scale, okay? So, and this would be, the source is Real Capital Analytics. I didn't ask them what their sample is for which apartments. I don't know how many there are. I don't know where they are. I don't know how old they are, but you get the point, right? So on the top on the red is cap rates. The bottom in black is the 10-year treasury, right? Which most people that buy apartment communities are going to own them long term, borrow against the 10-year treasury. So on the left side, it's 2001. And I'm actually being generous, because if I would have had this chart go back further, you would see, the 10-year treasury was higher than this. So what happens is when investors look at, I'm giving you sort of a longer answer to your question, partially because I don't really have a good answer to your specific question. So what happens is, in normal times, investors, and I'm talking about institutional investors, They have choices. They can buy treasury bonds, they can buy corporate bonds, they can buy all sorts of things. They can buy stocks, they can buy real estate. To induce them to buy real estate, you got to pay them a premium over what they get from government bonds, obviously, right? So historically, and when I say historically, I really mean in the last 10 or 15 years, investors have paid, investors want a 300 basis point premium to the 10-year treasury to own apartments. So what does that mean? If the 10-year treasury is 5%, they're probably going to be looking for about an 8% return owning apartments, which generally means maybe the cap rate's 7.5 or 7. They get a little bit of spread by having growth, but call it the cap rate. So, historically, the spread's been about 300 basis points. Right here, when the spread got down to under 100 basis points, that's like 06, 07. The reason that was happening, two reasons. One is, asset bubble, people paying too much for apartments, and the other reason was condo conversion, driving cap rates down. Buyers buying apartment complexes had nothing to do. They weren't buying it for the cash flow. They were buying it for to convert it to condos. So spread narrows down. Today the spread is something like 450 basis points. It's wide. But the reason it's wide is because the treasury bill's low, right? So if you were to, when we do our underwriting, so which we're in the middle of right now, underwriting, I don't know how many apartment deals right now that we're looking at buying. Call it, we're paying a 6 cap, okay? But we can borrow money today at 3 or 3.5%. So a 6 cap, if you can borrow at 3.5%, feels pretty good, right? You get good current cash, everything works, right? We're going to buy that apartment complex, we're going to spend money on it, we might pay 80, 90, 100,000 a unit to buy this apartment complex. We're getting a 6% return. We'll invest $5,000 or $10,000 a unit on upgrades, and we'll try to move the rents up by $100 a month. And we get a couple of years of rent growth, we hope, and before you know it, that 6 cap that we paid 3 years out after we finish the renovation, after we've gotten some rent growth, is more like an 8% return on our cost. So if we have an 8% return on cost and we can go resell it at a 6 cap, we make a pretty good profit. So that's 3 or 4 years out. But we're making that investment decision today, and we've got to figure out, geez, what do we think cap rates are going to be 3 to 4 years out? So we don't know, right? If we knew, we probably would play a different game, right? So what we tend to do is if today's cap rate is 6%, we're going to assume our exit in 3 or 4 years is 7% or 7.5%. We're going to give ourselves some room. But frankly, we don't know if that's enough room, right? Because most of the people you talk to, if you were to ask them, and if you were to look at this chart, this 10-year treasury, it's up there, it's up at 5.5%. It's really not that high historically. It's up at 5.5%. The Fed eases, it gets down to what? I mean, it actually recently got down below 2. I mean, this chart actually got sub 2 last year. And when they start going up, they go up really fast. So if the 10-year treasury is at 5% when we go exit the property, and this spread that investors want is historically about 300 basis points, means investors are going to want about an 8% return to buy apartments. If we've underwritten to a 5.5 or 6% cap rate exit, we're going to be in trouble. We're not going to be able to exit at that price. So by buying value add, growing the income, getting to a higher return, if we're wrong about cap rates, we'll just make a lower return, we hope, right? But frankly, that's all we can do. We've researched till the cows come home trying to hedge against rising cap rates. And what we found is there is no instrument that we're aware of that can actually directly hedge rising cap rates. You can hedge the 10-year treasury. You can hedge it left and right all you want. But the research we've done on that is it's incredibly expensive. It's not worth it. It kills the whole profitability of the transaction. And the other problem with hedging the 10-year Treasury right now is what I just described, the joke I made about, oh, you think borrowing Treasury rates are going up? So does everybody else. So to hedge on that side of the trade, it's very expensive.
You've got a natural hedge, you've got a rental.
We do.
Treasury rates are going up just because the Fed's feeling better about the economy. Economy's improving,
Right.
GDP's increasing, rents are increasing,
Right.
vacancies are decreasing. So
Right.
you've kind of got a natural hedge in the rental. So the exit cap rate may be higher, but you're underpredicting the cap rate, but you might be underpredicting what rents are going to be capitalized at that higher cap.
Correct. Which is certainly true for apartments. Tougher on retail, right? Because when we're buying anchored retail, anchored or not, shopping center business, there's rent, there's leases. The leases have, typically for the anchor tenants, have flat rents and have long option periods. So the rent that Publix pays us today at Jacaranda Plaza is going to be the same as the rent they're paying us in 5 years, regardless of what happens with inflation. We can't reprice that. So the one nice thing about apartments is you get to reprice them every day, and the longest lease you ever have to live with is 1 year. Yes? Sure it does. I don't do it. Like I don't do it, and that's not like the thing. It's hard. This is actually one of the challenges for us since we've sort of moved into this model of being in the private equity business. We sort of learn a different language. Our role, like our institutional investors, like one of the public pension plans that we have as our investor, they have 8% of their assets in real estate, right? And we're maybe 5% of their allocation, right? So what is that? We're 0.4% of their assets. The decision about how much they should put in real estate is being made by, actuaries and consultants. And so real estate plays a role in their overall portfolio. And so whatever exposure they get from other assets is theirs. We like to say real estate's a hedge against inflation. The thing that's, I think, most nerve-wracking about the current rate environment in our business is historically, exactly what you said, historically is true. If rates are going up, that means inflation's going up, that means the economy's growing, that means everything's growing. There's a large camp that believes that the 10-year Treasury could go to 5% or 4% without there really being wage inflation for the universe of people that rent apartments, right? So that translates into higher rents. And there's a great argument that can be made for that. And so that's why it's a unique time to be in our business, because we're like, you're sort of having to manage, like we spent the last 2.5 days like looking at real estate and looking at, should the pulls on the cabinet door be brass or brushed nickel, and how much they spend $300 on that? Can you do the 6-panel doors instead? I mean, little decisions. And what does the landscaping look like? And how do we feel about this property versus another property? You make all those decisions, you talk to the analysts, you change assumptions in the Excel model, all that stuff. Like, that's all great, that's all important, that's the only thing we have control over. But by the way, our outcome at the end of the day is going to be way more influenced by this damn table, frankly, than how well we execute. So some days that creates a headache for me. Most days recently. But you have to, that's one of the, when the wind's at your back with this stuff, I got to tell you, you feel like you can't miss, right? And when the wind's in your face on this stuff, you feel like you can't do anything right. You feel like no decision, it's hard to get confidence in hard to be confident in your decisions. So we're at this point where the wind's been at our back like for 2 years maybe. And it's starting to feel like maybe the wind's sort of coming around a little bit. Now it's at our side. Could be a fake. Could be it's going to go back to our back. Could be it's going to be in our face. And so The question is, how do you set your business up, which I think we've done? How do you make investment decisions, which we're trying to do, so that you know during the life of the investment the wind's going to be at your face at some point in time? So how do you make those decisions in a way that helps you withstand that? A lot of what we talked about earlier. Modest leverage, smart underwriting, buying at discounts to replacement cost, buying good assets. Like at this point in time in the cycle, the temptation, which we've succumbed to, is I got to get these high returns. The stuff I really want to buy, everyone else wants to buy, there's capital flowing. I can't get these returns from this kind of stuff, so what am I going to do? I'm going to go buy this stuff in podunk towns where no one else is, or I'm going to buy stuff that's a little riskier, a little messier, a little harder to do. So I'm going to go up the risk spectrum. Locational risk, execution risk, to try to get those returns. What invariably happens if you sort of go up the risk if you go up the risk scale locationally, I've regretted it every single time. I've never had an outcome where it's like, oh, I'm so glad I bought that piece of junk in that junky town because I got a good deal on it. I've always felt like, oh my God, why did we do this? So I don't know if that answers, it's a long non-answer to your question. Yeah.
Talk about some of the different divisions we have in house. Have you always had development,
Yeah, so we have a development group, we have an asset management group, property management under them, leasing, and then all the all the accounting, control, reporting. Hasn't really changed, not really. The development department grew really big, got really small, got a little bigger again. The asset management group's always grown. The analyst and investment group's always kind of grown. The thing that's grown in the last few years is, we have somebody that's a compliance officer, because now I talked to you guys a little bit about earlier that a lot of what we do is regulated by the SEC, so we have somebody that does compliance. We have, between lawyers and paralegals, 3 or 4, we used to have 1. We have somebody that's dedicated to fund accounting. Didn't used to have that. We have a tax specialist dedicated to that. She helps us with structuring before we make an investment, because I could spend hours talking in the fund. There's all kinds of structuring because we have tax-exempt investors, we have offshore investors. They each have different needs, so we have to structure our partnership sometimes to structure around tax issues. So there's technical back office stuff that's grown. But other than that, it's really been fairly consistent. While I'm on this slide, and I've sort of delved into how I see things kind of in my answer to that previous question. So this same chart, here it is for retail. And you see it's not too dissimilar. But the one thing is, the spreads historically for retail are 75 basis points to 100 basis points wider than multifamily. That's because, really, multifamily is viewed as a less risky asset than retail. And today, the spread between retail versus multi is even wider. And that's in large part because of the threat of the internet, and also the fact that in a rising rate environment, if you think there's maybe going to be any inflation, retail doesn't give you as good a hedge against inflation as does apartments. You also have less operating leverage. I mean, the best asset to have as a hedge against inflation would be a hotel, because your leases are 1 night long. So that's that. The other thing I wanted to show you was this, talking about apartments, just real quick. Remember I told you that we put this book together, the other book, together in 2011, and we've kind of modified along the way. We had this chart in the book in 2011. Today's version, we took it out. So if you notice, like in 2011 when we were pitching, this gray line here is annual starts of apartments around the country, right? So historically, the average is about 300,000 units. You can see that peak there, which is in the mid-'80s. It hit about 500,000 units. Then we had this big, huge chunk here during this long period of prosperity where it was about 300,000 units, real boom time for apartments. Then right here when we were pitching, it was down to like 60,000 units. So part of our pitch was, pent-up demand, historically low supply. This is from 2011 to today. So it sort of has gotten back very quickly back to historically normal levels. And we've had really good rent growth, and that's in large part because there was no new supply. And apartments, pretty much, once an apartment reaches a certain age, it either becomes functionally obsolete or the renter profile changes. So you need sort of 1 or 2% of the supply to be added every year just to kind of keep up. So when there's no new supply, there tends to be pent-up demand for high-quality product. You start to introduce high-quality product, you get good rent growth. This red line, which there's been article after article written about, and I don't have an opinion or a prediction because I don't know enough, but this red line is the percentage of the U.S. adult population that owns a home. So it's at like 64% back there in the mid-'70s. It's kind of stayed between 64 and 65%, even going way back. I think the first time it spikes, is after World War II. Goes all the way to the mid-'90s, and then it makes this steep rise from 64 to almost 70%. And each 1% is about 1.1 million households. So this is, the great dream of owning a home. This is the nightmare of owning a home, right? So it goes down from 69.5 to about 65. As it started going down, people predicted it would go to 60%. And people said no one would ever want to own a home again, which now is not true. Right now, house prices have come back. This line, I think, you'll see it's going to end up settling out. But we picked up from 69% to 65%, we picked up 4.5 million households of demand for renters. So that fueled occupancy growth and rent growth. Now, a lot of that decline in home ownership, a lot of those people, probably no one in this room experienced this, but a lot of those people went back and lived at home instead of going out and forming a new household. That was an attempt at a joke, being facetious about people moving back home. So this is sort of interesting, but I think what's happening in the apartment business is now the supply of new development is now about where it should be. In some markets, it's probably too much. And that varies from market to market, and it varies from sub-market to sub-market. The other slide I wanted to show you is this. This is the commercial property price index. The one in blue is called, it's the Green Street Index, okay? Green Street measures institutional quality trades. So it's one institution selling to another, and it's dollar weighted. So if a $1 billion office building in Manhattan trades, it's 100 times more important than a $10 million shopping center in Orlando. Okay? That's the blue line. The red line is a Moody's index that tracks just the apartment business, and it tracks every apartment transaction over $5 million, and it's not dollar weighted. So every transaction, private people trading apartments, institutions trading apartments, not dollar weighted. The black line is the same thing, but for shopping centers. So if you think of it, the black and the red line are really more a proxy for what's happening in the normal, everyday real estate market. And the blue line is a proxy for really how big institutions think. So from 2000 to 2007, all these indexes just run up. They run up about 90%. And you can see retail actually ran up a little more than apartments. And you can see from 2007 to 2009, and by the way, the institutional index, the big asset index, bottomed earlier and came back faster. The red line is the multifamily piece, which bottomed next and has come back. It's back above where it was before. And this black line down here is the retail, which has kind of bumped along, although now it picked up some steam. Remember I told you this book, this pitch book we had, has changed along the way? So here's when I started raising the money, right? It was there. The pitch was, look, all these trophy assets have come back in these markets where we invest. Values haven't really come back. There's still room to go, which turned out to be true. We just didn't really get all the capital out as fast as we could have. But so values for institutional assets are back above their peak. Values for apartments are back above their peak. Values for shopping centers are about halfway back to their peak. So interesting environment today, and that wasn't true just 24 months ago. And I got one more slide, and then I'm done with slides, and I'll get back to questions. This is transaction volume. This is in billions of dollars. Top number is 25, so the scale is 5 billion per line across. I don't remember if that's the X or Y axis anymore. I've forgotten that. The red is retail. The gray is multifamily. And this is just in our target markets, which is Nashville, Charlotte, Raleigh, Atlanta, Tampa, Orlando, and all of South Florida. So, you know, in normal years, there's $5 to $10 billion of activity. In 04 through 07, it averaged about $20 billion of activity. It's great if you're a broker. 2009 in the bottom, it's about $4 billion of activity, about 75% of which was trades of distressed assets. 2012, it's about 17 billion. And through the first 2 quarters of this year, it's about 10% higher than it was last year. I didn't annualize the number because Q3 and Q4 is much higher always. So it's still growing. So, you know, and if I were to go back, maybe the range of the cycles is different. Maybe the depth from peak to trough is different. But it always does this. Always. You know, we're in a cyclical business. We've had a 3-year run of things getting better. It might keep getting better for another year or two, I'm not quite sure. But we're seeing anecdotal evidence, specific situations that we've experienced in the last few months where things have gotten hyper competitive. Definitely in the apartment space, less so in the retail space, but it's also happening in the retail space. So it's getting more challenging today to do real estate investing. But we keep at it. So that's the last slide. So now back to questions, because I know some people had some other questions. Yes?
Yeah, I have a question. Earlier you commented on the way you secure financing through capital, and you have investors that provide pledges of capital. Combine that with lines of credit from banks. Do you or the banks have any concern that the investors, the equity investors, may not be either willing or able to meet the calls when you come through, either intentionally or unintentionally?
Right. Good question. So, first of all, just to be clear, we use the subscriptions to secure a short-term line of credit. We use that line of credit for like 90-day fundings. We borrow first mortgage debt on every transaction. So we borrow about 65% of the cost of the transaction, typically from banks or insurance companies or finance companies. But your specific question about the equity, what I can tell you is that in Fund 2, which is the fund that was raised 06, 07. In '08, early '08, we had called about 40% of the capital, and we report on what's called a fair value basis. Every quarter we send out a statement, and we say what the capital's worth, what your interest in the fund is worth. So sometime in '08, in some cases, these investors had closed with us only 6 months prior, a year prior. Say you had committed to give us $10 million. We would have called from you by the end of '07, early '08, we would have called $4 million of your $10 million, and we send you a statement that says that $4 million you've given us is worth $2 million, which happened to everybody. That was really not fun, sending those statements out and then hearing the phones ring. But they were getting that from everybody. It wasn't like it was a shock. We made, I think in Fund 2, we made probably 25 capital calls, 20 of which came after that low point. And we had 25 investors. And every single investor, every single capital call, made the capital call on time in full. So during the worst of time, they made the capital calls. So to answer your question, I'm not really that worried about it. The banks, in terms of that line of credit, like on the current fund where there's 150 million of pledges, the line of credit's $40 million. So the banks give themselves enough room in case somebody doesn't fund. But the documents have pretty tough consequences on a non-funder. So basically, it has a steep dilution provision, which is basically if they've funded 40%, if they don't fund, I can basically take their interest, which is pretty tough. But there's no, and in some cases you can enforce, from creditworthy institutions, it's a promise to fund. So you can sue to enforce it. That would be suicide. I mean, I don't think anyone's ever done that, but you can. That's it? Oof, I didn't do a good job. Sorry. Okay, yes.
I just wondered, what are your general thoughts on mixed use development considering that sort of early stage of public transportation, higher mixed use development?
Yeah, the most money we've ever lost on any one transaction by like a factor of 10 was on a mixed-use transaction in South Florida, where there's no public transit, where my office is every day, where I have to go every single day and see it and feel it and think about it. Looks great though. Look, I think, and by mixed use, you're talking about vertically integrated mixed use. You're not talking about buying 20 acres and doing 5 acres of retail and then doing an apartment complex behind it. I think it works in very few places. Very, very few places. And in South Florida, I think in certain circumstances it can work in places like West Palm or Delray or Boca or maybe Fort Lauderdale. Certainly in certain locations in downtown Miami, on Brickell, on the beach. But without real transit, it's hard, it's hard to make it work. I mean, it really is. I mean, the issue is the infrastructure costs. Like we actually were just there today. We built a true mixed-use project in downtown Chapel Hill, North Carolina. I mean, that's worked. It's working. It's an urban environment. They have a serious bus program, but it's not, it's not rail or anything. And that project worked because it's a public-private partnership, and we got the land for free, and government paid for half the parking. So, in a location where somebody can buy a piece of land and build a condo tower, or buy a piece of land and build an apartment tower, to make a real mixed-use thing work, there has to be some driver to make somebody want to sell the land for less or make it be that much more valuable. And And so I think it's very difficult. And what happens is government forces people to do it, which is what happened to us in Palm Beach Gardens. I wasn't going to say where it is, I just did. But and you know, it ends up not working. So now over time, I think as the areas get more dense, there's more population and it's walkable, it starts to make sense. But unless you have real mass transit or it's a walkable area, you know, it makes no sense. My first experience with this whole sort of push for new urbanism and putting buildings up on streets and making things walkable, we were doing a Walgreens in a city in South Florida, and the planner said, like, this is great, I'm glad you guys are here. Like, the building needs to go up on the road, front door on the road. You can't have, you know, as many parking spaces as you want. You have to have less parking. It needs to be walkable. And I was a little younger then. I was a bit of a smart ass. I said to the planner, like, I'll make you a deal. Because, by the way, this road that this was on, where they wanted this thing to be walkable, was an 8-lane, median divided, 45 mile an hour, 65,000 car a day, walkable environment, right? And I just said, like, if you can get traffic calming done, shrink it from 8 lanes to 2, reduce the speed limit to 25 miles an hour, I'll build you sidewalks, I'll make this whole thing walkable. Because it's dangerous to walk there, let alone making it nice. So I think there's a lot of locations where there's a disconnect between what the real built environment is and what government wants, but there's some places where it works. Yes? Wow. Really? At the end, I get that question? Yeah. Well, you know, we lose them to the MBA program here. Chris, we lost to the MBA program here. What do we do? I mean, you know, we try to do a good job recruiting, right? I mean, in that, you know, the whole recruiting model is, you know, but I mean, I think we have a really good work environment. We pay competitively. It's a healthy environment, good benefits, promote health and wellness, promote upward mobility in the company, big on training, continuing education. A lot of programs like that big companies have, we have as a small company. But honestly, a lot of it is, you know, being slow to hire and quick to fire, which we've been good at being slow to hire. We've been a little weak at being quick to fire. But, you know, you make a lot of mistakes on hiring. I don't know how companies get it right, you know, 90+% of the time. I think it's very hard to do well. And I think it's important to have good communication with people and tell people, give them consistent feedback, honest, direct feedback. And, you know, getting the people, you know, we have good tenure at our company. We have, I think, a very aggressive program to share profits deep down into the company with a lot of people in the company. And I think that helps. But, you know, back to that thing with the wind being at your back. I mean, if you're doing interesting things and making money, it's easy to attract and retain people. If you're not, it's tougher. And so, you know, one of the things we have is stability and sustainability in our company, so it doesn't get super big and then shrink way down. And then we've expanded geographically. We're active in most of these markets where you see stars behind me. And so that gives people an opportunity to grow. We've relocated a few of our people out to these markets where they get to kind of grow their own business. So we try all those things. It's as good an answer as I've got. You know, if you guys have ideas about that, you should tell me. I mean, it's more relevant what is appealing to you guys than what I think works. It's different. It's a challenge. Any other questions? Yes.
Earlier you commented that one of the things you attempt to do is raise rents going forward. You also mentioned that you don't see much wage inflation. Is not
Yeah, I mean, there is another variable in that. So there's a couple of, and I'm like shopping. I'm talking about apartments really, where we have a lot of influence on raising rents. The shopping, we've owned, I don't know, 50 shopping centers or 70 shopping centers at one point in time or another. I don't ever remember feeling like I had like heavy pricing power, other than a few times. So I don't know much what it's like to raise rents in shopping centers. I mean, if you do a good job and you renovate and you fix it and there's high anchor sales, you can raise rents. But that's less about what's happening in the economy at that moment. On the apartment side, the variables that you're not focused on really are twofold. One is fundamentally there is a relationship between supply and demand, right? Because in most markets there's a finite number. I mean, if you want to live in a certain neighborhood, if you're a young family and you want your kid to be in a certain school, if you work near where our apartment community is and you don't want to walk or you need to be close to work for whatever reason, there tends to be very well-defined apartment submarkets, and some are more desirable than others. And there's a real relationship of supply and demand within those submarkets. So you could have a market that's 92% occupied. I mean, Palm Beach County may be 92% occupied, but within 3 blocks from Atlantic Avenue in Delray Beach, where we actually had a project that did very well, it could be 99% occupied, which is effectively 100%. And in that case, you just have pricing power because of supply and demand. Just simple, don't really care what someone can afford or not. There's enough people that can afford it that want to be there. So you could move rents there without there being real wage growth because there's just a supply and demand relationship. The bigger trend, particularly in new development, is smaller apartments. So the average apartment size that we're building today is probably 850 square feet. 5 to 10 years ago was 1,000 square feet. So we've got smaller 1-bedrooms, we're building studios, smaller units. So if before you wanted to live in a 1,000 square foot apartment, the rents were $1.25, I could charge you $1,250 a month. Now I'm going to build a newer, cooler deal in a better location with cooler amenities, but you're going to have to live in 700 square feet, and I still want your $1,250 a month. So I'm going to charge you whatever that is, $1.85. So I'm going to grow rents per square foot, which is really what I care about. You're going to still pay the same number. You're going to have less space, but it's in a cooler building in a better location. So that's the other way you can move rents without really wages moving. People's behaviors are different. People are, younger people today are wanting less space. I mean, they'd like more space, but they're comfortable taking less space than they were 10 years ago or 20 years ago. Anything else? Any other questions? All right. Right. Oh, wait, did you have one there? Yeah. The football team. I don't know. I mean, it's generally been, and I think it probably goes back to its history as being a military town. I mean, it's generally been more blue collar, at lower incomes than other parts of Florida, and so it's attracted sort of less investment. It's also a low barrier to entry market. I mean, obviously there's the water on the east, but there's, it can go straight down 95. It can go straight out west. It grows, sort of without much barrier, similar to Orlando. And so we personally as investors there have not had much success. The other issue on the apartment market is, back to that wage thing. I mean, the average rents in Jacksonville, I don't know what they are, but I'll bet you they're on average across the market for a product. I'll bet they're 15% less than what they are in Orlando. Maybe more, I don't know. But you got to build the apartment the same way in Orlando that you do in Jacksonville. And so the land cost maybe is lower in Jacksonville than it is in Orlando, but that doesn't make up enough of the difference. And then the final thing is institutional investors, right, which drive values of these assets, the assets I'm interested in. They just want, they want to be in major markets. They want to be in markets that have a population well above 1 million, sometimes above 2 million. And, in Florida, Jacksonville sort of falls off that radar screen. So there's nothing wrong with the place. It's nice. The beach is nice. All right. Well, thank you, guys. Thank you. And ladies.